Hey guys, what's going on? Welcome back to the channel. So I was just going through making a contribution of $12,000 into my Roth IRAs, and I want to kind of share what we're doing here so you can follow along. So none of this is stuff that I haven't done in the past on this channel, but I thought maybe a real world example could help you do the same and give you some pointers so you don't make some mistakes that are common. So to start with the $12,000, it's not just for me, it's for my wife and myself. So $6,000 for myself, $6,000 for my wife. But here is what I'm doing. So I wrote it up on the board so we can kind of go through this together really quickly. So with the Roth IRA, you have income limits, and the income limits for 2022 for singles and married filing jointly. The phase outs for singles is $129,000 to $144,000. So if your modified adjusted gross income is above $144,000, and the modified adjusted gross income adds a few things back, one of those is student loan interest that gets added back. That's the modified part. But for a lot of people, it's just going to be your adjusted gross income. $144,000 or more for singles, you cannot make a direct contribution to your Roth IRA. Married filing jointly, that number is $214,000. Again, these are the phase outs, and I've gone over phase outs in other videos, so you can check that out. But if you're over these thresholds, you have to do it a different way. So it gets a little almost convoluted. So here's how I'm doing it. So we're gonna do a backdoor Roth, but that's not the only thing that we're doing here, so pay attention. With the traditional IRA, I'm making a non-deductible contribution to my traditional IRA, and then we're going to bring it over to the Roth. That's the backdoor Roth conversion. So it's an after-tax contribution, then roll it to the Roth. If you can do that without what I'm about to show you, then great. Otherwise, you're going to want to stick with this. So I'm making my non-deductible contribution. Here's where people get tripped up. So with the traditional IRA, you're going to have your deductible portion and your non-deductible portion. Your deductible portion, the pre-tax dollars, maybe you've rolled it over from an old retirement plan like a 401k, 403b, rolled it into your traditional IRA. That's the deductible portion that we're talking about. You have to take an equal ratio of your deductible and your non-deductible portion when you convert. That's called the Prorata Rule. Now, this could get messed up for some people because the Prorata Rule is not done at the time of conversion. It's done at the end of the year, 12/31. So it's based on those balances. Now it's going to pull in whatever you can convert throughout the course of the year. You're not going to wait until the end of the year. You might, but you're probably not. You're probably going to say, I need to do a conversion. Let's convert these dollars, make that non-deductible contribution. That's exactly what I'm doing right now. So you're going to have a pro rata amount, and that pro rata amount will inevitably raise your taxes because now you're taking pre-tax money, converting it over, which makes it taxable, okay? We're going to get around that. How do we get around that? We're going to take our deductible money, and I'm going to roll it into my solo 401k, my traditional solo 401k, because 401ks, retirement plans at work, minus the SEPs and the simples, are not subject to the Prorata Rule. So we can get that money out of here, okay? Now let's say that you've already done this and you're watching this video and thinking, oh my goodness, I'm gonna be subject to the Prorata Rule. I did a non-deductible contribution and put it over. It's based on 12/31, so you still have time to get all the money out. Just get the money out of here, put it into your solo 401k. Now real world, you're going to have some timing in here, so don't wait until the last second at the end of the year. Real world, you're going to roll it over, and that could take a couple of days. You might need some paperwork to journal it from this account to that account. Or if you don't have a solo 401k, or if your accounts are at different firms, all that is going to play a factor in the timing of it all. So you just want to pay attention to that to get it done. So you're going to take this money and put it over to your solo 401k. If this account goes to zero, make sure that it doesn't get closed as well. Some institutions will close it if there's a zero balance. Some will not. Again, you just want to, real world stuff, you just want to make sure that that occurs because you're inevitably going to make another contribution at some point. So we will make that non-deductible contribution here. We can convert it over here. So we're going to do that $6,000 here. And because we cannot make the contribution because we're probably going to be over these thresholds. Now, if you're not sure if you're going to be over these thresholds, you can still do the strategy because then you don't have to deal with the excess contribution next year. If all of a sudden, oh, you know what, we got a bonus, we made a little bit of extra money, we're over these these thresholds depending on your filing status, then you don't have to worry about it if you do the backdoor Roth to begin with, because there's no income limits on that strategy. The total contribution limit is $6,000 if you're under the age of 50. For 50 or older, it's an additional $1,000, bring that total to $7,000. Now, could you do this? This is what I wanted to talk about too. I have a solo 401k. Could you do this with your workplace plan? Could you do this even with your own solo 401k? The answer is yes, but it depends on your plan documents whether or not they can accept contributions from other retirement plans. Likely that you can do it. I just want to point that out. You also need to look at your plan documents. Would I do this if I had a workplace plan though? I don't know. You know, I typically don't like to do that because I have full control over the investments that I'm choosing in my retirement plan. Now, if I'm doing it myself, but you know, I didn't care about the individual stocks or the actual investments, then maybe. If you have a well-diversified 401k at work, then maybe you would want to do it. But usually I would shy away from doing it through your workplace plan because you're limited on the types of investments. That's why I like the solo 401k. But this other thing I want to point out too, if you have a side hustle or the ability to have a side hustle, then that income, you can basically say, I want a solo 401k. You can have a side business and open up a solo 401k, and they're basically free. I mean, I have custom plan documents for mine, so I can also do a Roth conversion in plan. But if you don't need to do anything like that, then just open up a solo 401k with your side hustle, roll the money in, still maintain control. If you don't have a side hustle, maybe this is the time to get one so you can do this strategy, because this could be significant for your financial future, especially if you can still maintain control over your investments. So the solo 401k, you can roll these assets over into your solo 401k and get it out of there. Then you can do your conversions. This is exactly the strategy that I'm doing right now. So literally I have zero balance in my traditional IRA right now, and we're putting in the $6,000. Then we're going to convert that over as a non-deductible contribution because we cannot make it in directly into the Roth, and the income limits to make it into the traditional IRA pre-tax, if you already have a workplace plan, is even lower. I don't know what those are off the top of my head, but it's significantly lower. So therefore, that is out of the question. And this is how I can get $12,000 more by doing it for myself and my wife at the same time. And I'm also doing pretty much the same thing with the solo 401k, where I'm putting as much as I can on the traditional side, and then what's left over as a non-deductible contribution goes over to the Roth solo side of my 401k. So I just wanted to kind of run through that to point that out. So get a solo 401k if you can. I don't know if I would do it if I had a workplace plan that had a limited amount of investments. I like that control. I like to even choose the exchange traded funds or the individual stocks myself. Obviously, that's what I do. So that's why I like that type of account better. But again, if you're doing it on your own and you feel perfectly fine with your workplace plan, there's nothing wrong with it, but it's not my plan A that I would choose. Do that, the conversion, and then get the $12,000 over. So if you have any questions on this, let me know in the comments down below. If you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.